My guest today is Doug Marshall. He's with Marshall Commercial Funding, and he's here today to talk with us about lessons we can learn from the Omaha Oracle, Warren Buffett. Doug, how are you doing?
I'm doing really well. How about you?
I'm good. It's been a little while since we've talked. Can you, before we jump into this, can you do myself and the listeners a little reminder, share a little bit about what you do over there at Marshall Commercial Funding?
Yes. Marshall Commercial Funding is an independently owned commercial mortgage brokerage company that I founded in 2003. And I've been in the real estate business principally on the finance side for about 30 years. I've been in commercial real estate for almost 40.
Got it. All right. So the information we wanted to talk about today was some investment ideas from Warren Buffett
Yes.
with respects to real estate. And
Yes.
You had some insight on his view of real estate, and what's your view on Warren Buffett's view of real estate?
Well, I've enjoyed learning all about Warren Buffett's commercial real estate ventures. As you already know, Warren Buffett is the CEO of Berkshire Hathaway, and he made his considerable fortune investing in the stock market. Last year, Fortune magazine ranked him as the third wealthiest person on the planet with a net worth approaching $80 billion. That's billion with a B. That's not too shabby. And but unknown to most people are Mr. Buffett's two small real estate investments, and they're really not small. They're small in comparison to all his other assets that he owns. And he made these two investments many years ago, and he has been amply rewarded for his willingness to invest outside of his area of expertise. And far more important from our perspective is that he learned 5 common sense principles from his real estate investments. And before I get into what those were, let me give you a brief explanation of his 2 real estate investments. So the first one he purchased in 1986. He purchased a 400-acre farm located outside of Omaha, Nebraska. He purchased the farm from the Federal Deposit Insurance Corporation, the FDIC, who had inherited it from a bank that failed. And Mr. Buffett admits that he knows nothing about farming, but he has a son who loves to farm, so he turned the day-to-day operations over to him. And although Mr. Buffett admits his lack of farming acumen, he could easily recognize that purchasing the farm was a good investment decision. As he said, I needed no unusual knowledge or intelligence to conclude that the investment had no downside and potentially had substantial upside. And 3 decades later, the farm has tripled its earnings and is now worth 5 times what he paid for it. So his gut instinct proved him to be true. And then secondly, he purchased another property. This time in 1993, he purchased a retail property located adjacent to New York University that the Resolution Trust Corporation was selling. A real estate bubble had popped, and the RTC had been created to dispose of assets of failed savings institutions. And his investment analysis was very rudimentary. The property had been poorly managed by the previous owner and then by the RTC. The vacancy at the property was well above the market's vacancy rate for no apparent reason. And the largest tenant's rent was only $5 per square foot compared to all the other tenants' rent averaging $70 per square foot. He realized that when the current lease term expired for this particular tenant, that the new rent on this space would improve the property's cash flow dramatically. And like the time he purchased the farm, he realized that he needed to turn the management of the property over to an experienced property manager, which he did. And over a relatively short period of time, the property manager was able to lease the vacant space and to raise the market or the rent on to market on the building's largest tenant. And as a result, the property's net cash flow tripled, and annual distributions currently have exceeded 35% of its original investment. So those are Mr. Buffett's two attempts at real estate investing. And both, as you can see, are very highly successful. But as good as his results were, the principles he learned were priceless.
I'll say, I mean, tripling and 5 times the value. I mean, it took some time, which I think is, probably true with most long-term assets. You're going to see, similar, well, not similar, but you would hope to see appreciation or larger returns. But that's pretty significant. I'm kind of curious if you're to hold that up to like the S&P or the Dow or whatever over time, how that would track as far as the percentages. I don't know.
Yeah, that's a good question. I don't know the answer to that. I think I know the answer to a part of that. Whether it would be better than the S&P 500 as far as appreciation is concerned, that would be an interesting question. But one thing I do know, I'm very confident on, is that the cash flow that was generated from these investments is highly, it's substantially more than what they could have done with dividends or dividend stocks. They would generate usually, 2%
right.
return annually. Well, these cash flows were huge. And so from that perspective, I'm absolutely confident that it was a grand slam compared to anything he could have done with the investing in equities.
Sure. No, and I'm assuming he probably paid cash for the real estate as opposed to leveraging. So, as opposed to if you'd leveraged into these things, even greater returns on your your cash.
Mm-hmm.
So, well, do you have any personal experience, in yourself, this type of real estate investment?
Well, I've never done anything with farmland. No, I never have. But yes, I have experience with, not with retail, but I have office and student housing and apartments for investments that I personally have invested in over the years. But what I think that's really interesting here is that Mr. Buffett was insightful enough to understand the principles of why he was so successful. And the first one, is that he noticed that if you notice, he bought both properties out of foreclosure when the real estate market was at the bottom of the cycle. I will tell you how to become wealthy, he once said. Be fearful when others are greedy, and be greedy when others are fearful. And he's probably one of his best known quotes. And when he bought these two properties, most investors were out of the market, fearful that real estate wasn't ever going to turn around. But Mr. Buffett knew differently and acted upon it.
And the thing that I think it's always remarkable about him is that he can, whereas I think everybody just gets, like you said, they get fearful or they get caught up with the herd and forget those principles, or they make a lot of sense, but the emotion of the moment, I think, is what's hard to master.
Yep. Absolutely.
All right. So you said your properties. How have they done? The properties that you've invested in.
Well, I as an example of learning that particular principle of buying when people are fearful. In 2009, at the bottom of the Great Recession, a group of investors, which I was one of them, purchased a 54-unit apartment out of foreclosure. And I remember how fearful I was. Was I making a good decision? Or should I be more prudent? Maybe I should be hoarding cash at this particular point in time, because nobody at that time knew how long it was going to take to get out of that particular situation with the the economy in a free fall. Everything on paper, though, told me I should proceed with the property. And after doing a gut check, I decided to go for it, which was contrary to my instincts. And looking back, it was by far the best real estate investment decision I've ever made. So I'm glad that I looked at the facts and I decided, it would be so easy not to, but it makes a lot of sense to buy this particular property, and we went ahead with it, and it's been a home run.
Have you sold any properties? It sounds like you've bought at the low. Have you mastered the sell at the high?
Well, that's a good question. I believe that right now, I think that our absolute peak of the market this time around was the summer of 2016, a little bit over a year ago. And there's still people that could argue one way or the other. There's no consensus on that. There are some people, I think, that probably think we're still in a rising market. But I believe really it was about the summer of 2016 that our market peaked. So if I had sold in 2016, I would have timed the market perfectly. And I remember thinking how frothy the market was and how I could sense that we were reaching a peak as real estate investors were buying properties at silly, stupid prices. I mean, really off-the-wall prices. However, I did not sell at the peak of the market. I did sell one in 2015, and I sold another one this year. So one of my properties I was a bit early, and the other one I was a bit late.
Gotcha. That's still, you're on either side of the crest. That's better than being in the trough trying to sell.
Yes, that's true.
So that's good. That's good. So on your personal experience, I mean, clearly that's, I think sometimes we get caught up in this timing thing, like the right time to get in, the right time to get out. Do you think there's what am I trying to say here? Is there a lesson, learned in that? I mean, is it, should you, pay more particular attention to the property? Is there a lesson? I mean, just with the numbers on the property and make sure it works for you, or not worry about the market? Is there a lesson there?
Well, I think that you can buy property at any time in the real estate cycle and make money. It becomes harder and harder to do it when you're at the peak of the market, but it's still possible. And the reason why that is that sellers don't always know how to optimize a particular property, or they poorly manage a property. And if you can come in with a vision for that property that the current owner does not have, that can substantially increase rents, then you can still buy property and make a very good return on it. But it's more difficult at the top of the market than obviously it is at the bottom of the market. The second principle that Mr. Buffett made was that he realized you don't have to be a real estate expert to achieve satisfactory investment returns, but you need to turn over management of the property to someone who is well qualified to manage the property for you.
That's an excellent point. I hear a lot of investors and kind of mentors, and I think everybody has kind of a different starting point as far as some people talk about the market, some people talk about the property, but I think that everybody that I've spoken to agrees that the strength of your team, starting with the property manager, is really going to determine your success with having a property that's well managed and cash flow and screening your tenants and maintenance and all that stuff. And I know personally I'd concur with that. That's definitely, and I've been the weak link in that when I've tried to manage some of my own properties. So
yes.
That's great. What about you? Do you have any experience with that?
Well, I've learned over the years that the best tool in my toolbox is my checkbook. And I really mean that. By that I mean I've learned to hire people to do the jobs that I'm not particularly good at, And property management is one of those tasks. You have to have a certain personality bent, and I don't have it. I would rather spend my time doing those things that I'm better suited for. Just like Mr. Buffett is keenly aware of his ability to invest in the stock market. He knows the principles. He knows how to do it. His expertise is not in property management of a farm and a retail property. And he was just smart enough to say, I'm going to turn this over to somebody that really that's their area of expertise.
That makes sense. All right, so we got the what do we talk about here? We said the what was the first one? The second one was you don't have to be an expert. The first one was he bought at the down, so he bought good value. I think that's right. Kind of a common theme with all his stuff. He turned it over to the experts, which I think is kind of a common theme with even the companies he buys. If I've understood the little bit that I've read about him, is he's not one to come in and monkey with management. He considers the management in place when he buys the asset.
Yep.
And so he's buying both the asset and the management.
Yes.
So what else have you learned here from him and his real estate here?
Well, the third thing that he learned is that you don't need to do a sophisticated investment analysis to determine whether to purchase a property. Sometimes we get really caught up in doing internal rates of return or net present values or whatever it might be. And he didn't do that. He just, he understood. He said, he used common sense. He looked at the property and he asked himself, what is holding this property back from operating well? And then he said, well, if I can answer this question, and correct the problem, then I'll buy the property. And both times he was able to do that. He saw that there were some real obvious things that needed to be done for both the farm and for the retail property that could be corrected very quickly. And he did it. And he didn't have to do an internal rate of return calculation or anything else to figure that out.
So how does that compare with investors you run into? Their analysis approach to Mr. Buffett's approach.
Well, I've learned this exact same thing from the years that I have helped finance properties for my clients, that those that are the most successful really have a very simple analysis. They don't go through any sophisticated analyses that are out there. They really understand the market well. They understand the property type well. They can look at it and pretty much do an analysis on the back of a napkin. And 9 times out of 10, they're right. Occasionally they get blindsided by something. And it isn't that they just stop with the analysis on the back of a napkin. They then go in and do the proper due diligence for the property to make sure that they're not surprised by either maybe the condition of the property or maybe they look at the operating statements or the rent roll to make sure that everything is as it was originally declared to be. But they realize that, this is not rocket science. It's not that difficult. It's a lot of common sense. And so Mr. Buffett and those who I've helped with financing over the years that have been highly successful have the same philosophy.
Well, I like it. Keep it simple. And like you said, is focus on a couple of things that might need to be corrected or that could cause you problems, as opposed to go deep down the analysis there and what's the paralysis by analysis kind of thing. But know those critical few things. That's good.
Yes.
All right, so that's 3. What do we got for number 4?
Well, number 4 is that investing over the long term will eventually solve most problems. Notice he still owns these 2 properties. One he bought in 1986, and the other he bought in 1993. As he likes to say, our favorite holding period is forever.
Well, I would say that's one way to assure you won't, or at least when you look back, you can always look back with fondness of, what a good deal or that you got or whatever. And I would tend to say myself, I believe in kind of the long-term hold. I know, flipping with single families is clearly an industry all by itself, and somewhat, even commercial properties. There's people that try to reposition them quickly and resell them kind of thing. But I think everybody has an investment strategy, and a lot of it has to do with I think probably the investors you're in with. If you're solo, there's fewer parties to answer to. If there's multiple, then your decision's probably going to be different there. But what's your experience on your properties?
Well, I must admit my holding period is not forever. I generally hold properties for 7 to 10 years, but those properties that are truly home runs, and I have a few of those, they've greatly appreciated, and they are generating double-digit cash flow, cash-on-cash returns. For those properties, my holding period will be a lot longer than 7 to 10 years. It could possibly be forever or close to it. Yeah.
Well, and like you said, if you had a good dividend stock, you wouldn't necessarily want to give that up unless you thought there was a concern of dividends going away or something like that. But
Right.
If you've got cash flow in real estate and appreciating rents and values, it's hard to argue against it unless you've got something a much better opportunity.
Especially, I'm 65, so I'm at that period of time in life where appreciating my properties is nice, but it's not my number one goal. My number one goal is generating cash.
And preservation of capital, right?
Yeah. So some point in time, I'm going to retire. I don't know when that is. I hope it's not for quite some time. But when I retire, I want to live at a level of income that I want to enjoy myself. And the best way to do that is to have properties that are not only appreciating, that's nice, but really are generating cash. And so if you can get a number of properties that are generating double-digit returns on your original investment, then boy, that makes it a whole lot easier to retire comfortably.
Yeah. No, it takes the anguish out of when to sell out of the equation there too. That's great. That's great. Yeah. So we got hold time, and forever is Warren's plan there. Are there any more principles?
There is one more. He didn't concern himself about their daily valuations, which is something, that if somebody who owns a stock can go and look at what the value of that stock is on any given day. In fact, any moment in time during the opening of the stock market, they can look to see what the valuation is. But he understood that he bought the properties at bargain prices, and that over time they would make good investments. And as he likes to say, games are won by players who focus on the playing field and not by those whose eyes are glued on the scoreboard. So his thinking is it's unnecessary to kind of find out the valuation on a regular basis. It's not needed.
No, that makes a lot of sense. I think there's a lot of people who make a lot of foolish decisions when you're always focused on the scoreboard. And clearly, it's easy to get caught up in the emotion of the market if all you're constantly, watching, oh my God, it's up, it's down, it's up, it's down, it's up, it's down, as opposed to having a kind of a long-term plan. I would think it certainly holds true with commercial real estate. What do you think?
Yes, it definitely does. And I think that, personally, this is my philosophy. If I'm buying a property, let's say it's a value add type of property where there's maybe some considerable improvements that need to be made, deferred maintenance, is significant. I would wait at least a couple of years before I assess how well the property is doing. It takes that long to be able to make those improvements for an apartment, to be able to raise rents, maybe move out some undesirable tenants, and so I would not even think about trying to figure out how well your investment is doing until at least 2 years after you purchased it. And then nothing wrong with maybe on an annual basis looking to see what you think the property is appreciated at and the cash on cash return is going to be. And in my opinion, doing it any more frequently than that does not allow enough time to pass to really have a good idea of how well the property is doing.
No, I think that's a great point. In fact, I was having a conversation earlier today with another guest, and we were talking specifically about that. He was sharing with me about a property that he'd bought, and how when they sold it 5 years, I actually think they sold it 6 years down the road. That the average annual rate of return was 15%, but he said it was a good 2.5 years before, based on repositioning the property, before I was making any money. And the conversations with investors was a little testy there in the beginning, but they were all very pleased at the end. But it's just, again, I think having that kind of long view of real estate. It's not a flip. It's not something where you're going to, like they show on TV all the time, where the people in 30 minutes have gone from a dump to a palace and ooh, ah kind of thing. It's a process. It's a business. A lot of it has to do, like we were talking here, about having the team in place, the timeline in place, or kind of the vision of how long it's going to take. And then just the market cycles and a lot of things you can't control. But just I think time is probably that one piece that seems to be the cure for a lot of those market immediate indications. Like if you're focusing on the price daily or whatever kind of things. That's good advice. All right. Well, that's the 5 principles of Warren on commercial real estate.
Absolutely. And I think I'm surprised how quickly he was able to assess what he did right. A lot of times people can't do that, and he's smart enough to figure out that because of these 5 things, he was able to be successful. And I think these are principles that all of us can learn from.
Right. Well, and I think it's always, I think one of the things I always enjoy when I hear Warren speak is how folksy he kind of makes it sound, and simple too. He doesn't make it some big, long, elaborate, it's so complicated you couldn't understand it kind of approach, but very kind of a basic, almost gut level. And again, I think the long view and buying right, buying at a discount and having long enough runway to let the thing mature and appreciate's good. Well, that's good, Doug. What's the best way for our listeners to get in touch with you and find out more if they'd like to get in touch with you?
Well, there's 2 really good ways. One is you can go to my website, which is www.marshall, that's my last name with 2 L's, cf.com. And you can take a look at my website, get an understanding of the various content that's there, including this particular talk will be on there. And or you can just call me or email me. My email address is doug@marshallcf.com. And you can call me, 503-614-1808.
Got it. I'll put all that in the show notes for our listeners, so you can find that in the show notes and get in touch with Doug. Doug, as always, thanks for taking the time today to talk. It's always good to hear from you.
Well, thank you very much for having me.
You bet. And for our listeners, if you like the show, share the show with someone you know. You can either use the share button on your podcast player or copy the the line there in your what am I trying to say? The address for the download or for the show there, and copy that and text it to somebody. Seems like more and more people are into the texting, and that'd be a good way to introduce somebody else to the show. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.